In today's video, we're going to talk about a strategy that has outperformed the S&P 500 by 2% per year since 1970. But that's not even the best part. It managed to beat the S&P 500 with half the downside risk. How did this researcher do it? What did he use? And can we replicate his findings?
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
Last week, we reviewed Meb Faber's GTAA strategy, which uses a combination of 5 different assets, well diversified, and combines them with a trend following strategy. Trend following has a lot of good characteristics, a lot of bad characteristics, and a lot of ugly characteristics. I think understanding the good, the bad, and the ugly with trend following will help you not only understand the strategy better, but also appreciate what it tries to do. So first of all, let's talk about the good. It's well documented amongst many research papers that, at least historically, using moving averages to enter and exit the stock market and other asset classes has historically led to above average risk-adjusted, and the key being risk-adjusted, returns. For example, this research uses the S&P 500 index from 1950 through 2015. You can actually access this research yourself at this website. And this is from a well-respected academic who has basically spent his entire life studying moving averages. And what he finds is that a simple buy and hold strategy often returns more than a moving average timing strategy. So in this particular case, the buy and hold S&P investor earned 11.6% per year, while the moving average investor earned just 10.9. However, the major difference between these two strategies is in the drawdown. So while the buy and hold strategy did in fact outperform over this entire period, which you can see here by the black line, the moving average strategy had significantly less drawdown. So for example, this chart represents the top to bottom loss in any given period, and you can see the buy and hold investor routinely lost 20 to 25% of their value, 30% of the value, and in some cases, 40 to 50% of their account value, which was okay, assuming they were able to hang on long enough for the market to eventually recover. However, these huge drawdowns are often problematic for people emotionally, and they tend to want to bail kind of at the worst possible time. So the idea with the moving average strategy is that you eliminate the downside or the potential for a massive drawdown event. So you can see that the moving average strategy, represented by the red line, did have occasions where it declined by 15% or 20, 25%. However, you really avoided some of these major losses, specifically in 2000, 2003, and the 2008 debacle. And speaking of 2008, this year represents the basically picture-perfect situation for the moving average strategy. This is the 200-day moving average, which is represented here by this more smooth blue line, and this represents the S&P 500's price. So you can see after the price crosses below the 200-day, the market went on to absolutely fall apart. So if you were following this moving average strategy, you would have obviously liquidated right around here at some point. Potentially, depending on how you have your strategy set up, you might have jumped back in here when it briefly crossed above, but you would have obviously gotten back out in a couple days later and missed out on this entire wild ride lower. Trend following is not all rainbows and sunshine. There are some ugly characteristics. But the biggest issue with the moving average strategy, and the reason it consistently underperforms, is that a lot of times selling at the moving average is the worst thing you can do. To illustrate, here's a snippet from 2015 through 2016. I got this chart off of TradingView. It's just the S&P 500 index by Vanguard, so the VOO ETF. And it shows the price of this ETF and its 200-day moving average. So if you were following this 200-day moving average strategy, you would have sold here, bought back here, sold here, bought back in here, sold, bought, sold, bought. You can see that there's just a ton of different head fakes. The other issue that you run into is that sometimes these things will gap down. So, for example, let's say you're at this trading day and the market's right on the 200, and the very next trading day, the market's off like, 6, 7, 8%, which is obviously a very extreme move. But in that case, just because you cross below the 200 doesn't necessarily mean you were able to execute at those levels. So these gap downs can cause a significant lag in your performance and are another problem with the trend following strategy. So the key is to distinguish between the moving average breakdown that is a buying opportunity and the moving average breakdown that is leading towards more significant losses in the future. So the first market, and the most common, is the price crosses below the 200, but all that is short-term volatility, and there's no real economic substance behind it. Maybe it's just headline news or fears or something like that, but it's ultimately not substantiated by loss in earnings. Then you've got a market that the price crossing below the 200 is because of actual real deterioration in the fundamentals of the economy or the businesses themselves. And that most likely means that you're either heading for or in a recession. So is it possible to distinguish between these two types of markets? Research from philosophical economics tried to do just that. In his own words, he says, "What I find particularly compelling about the strategy is that it makes sense," and I would agree with that. It tries to systematically do what any good human trend-following trader has to do to time the market well, which is distinguish between those downward price breaks that are real, that are going to be met with sustained follow-throughs to even lower prices, and those downward price breaks that are fake-outs, that are only going to produce whipsaw losses. So what you're probably wondering is, how does he do it? He uses two pieces of economic data, and I'll talk about those in just a second. But if both of those economic data are positive, then remain fully invested in stocks. So this would be indicating that you have a false break lower. So let's say the price for the S&P falls below its 200-day moving average. If the economic data is still good, basically this is predicting that this is likely to be a head fake and the market will ultimately move higher. However, if the economic data is negative, then the timing function turns on. So for example, let's say the market is moving higher, 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 but all of a sudden here you get a break in one of these economic data and they turn negative. This would then turn the timing function on to where eventually, if the market fell below its 200-day moving average, then you would move to cash. And the moving average he uses is actually the same that Meb Faber uses, which is the 10-month moving average, or roughly equivalent to the 200-day. So which economic indicators is he using? The first economic indicator is the change year over year in real retail sales. So this would be like, let's say retail sales are up 9%, but let's say inflation is 10%. Well, that means consumers are actually reducing their spending on a real inflation-adjusted basis. So that's the difference between this and actual retail sales. So retail sales could be positive but negative on a real basis. So this has historically been a very good predictor of recessions. You can see there are some head fakes here, but mostly whenever this falls below zero, you can see that you had a recession, which is denoted by these gray bars. So again, recession, and you got under zero, recession, under zero, recession, under zero, recession, under zero. And you'll find that basically each and every recession also correlated with this being below zero. Now the problem is you do have some head fakes, but that's where the price to 200-day moving average also tries to confirm this. So if this is below zero, that doesn't necessarily mean you're selling stocks. You're only selling stocks if this is below zero and the price fell below the 200. And you can see that most recently, this has again turned negative. So the timing function would currently be on. The second piece of data that he looks at is industrial production. So this measures not the consumer activity, but more of the manufacturing and business side of things. And so when this is under zero from a year ago, this also would turn the timing function on. And again, you see this has a very good track record of predicting recessions. So if either one of these is negative, then the timing function would be on. And again, you see that right now, this is negative, so this part of the timing function would also be on. So what would happen if you systematically would have followed this particular model going back to 1928? The author of the research paper backtested his result, and this is what he found. So the gray line represents the buy and hold asset. So if you just would have bought the S&P 500, the green line represents if you had just sold at the 200-day moving average. And you'll remember that our earlier research showed that from 1950 through 2015, the 200-day moving average strategy actually underperformed the market. But this, going back to 1928, shows that the 200-day moving average strategy still slightly would have outperformed the S&P. However, adding on these two economic components helped you avoid enough head fakes that you actually would have outperformed both, and by a pretty wide margin. So while it's very interesting to see his research, what happens if we do our own independent study of it and extend it from 2015 all the way to where we are now in 2023? I use a software called Allocate Smartly to check what the performance would have been had you continued to follow this. Relative to the common 60/40 portfolio, the growth trend timing strategy outperformed significantly. And keep in mind, this is a logarithmic scale, so really this portfolio, the 60/40, would have grown 10,000 to a million, while the growth trend timing strategy would have grown to 5 million roughly. Not only that, but you can see that the maximum drawdown compares really well even with a 60/40 strategy. So the maximum loss here was negative 25.5. The maximum loss for the 60/40 split was about negative 30, which was here. And consistently, the orange line, being the growth trend strategy, outperforms the 60/40 in bad markets. That also held up recently in 2022 when the 60/40 portfolio lost nearly 20%. The major negative for this strategy is obviously turnover. Again, you're looking at 96% average annual turnover for this strategy, so this is not going to be particularly useful in a taxable account. So this performed well against a 60/40 portfolio, but how did it compare against the S&P 500 over that time? Allocate Smartly doesn't have that on their website, but I did calculate this independently, and I found that from January of 1970 through February 2023, the S&P 500 produced 10.44% with dividends reinvested. And that compares with the growth trend timing strategy of 12.4. So you see a nearly 2% annual improvement using this strategy. So is this strategy right for you? Well, the answer to that question depends on your specific situation, but I would say if you held a gun to my head and you said, Nathan, you can either invest in a 60/40 portfolio or invest in this particular strategy as I start retirement, I think this strategy would be a no-brainer, at least for my IRA accounts. Now, if you let me choose any strategy I wanted, I would probably still stick with the buy and hold strategy simply because I don't personally mind the volatility. If my portfolio falls by 50%, I'm going to be continuing to add more and more money to it. However, for people that are a little more skittish, maybe they're wanting to have a way to exit stocks at potentially opportune times, I think this could be a really interesting strategy. Any timing strategy comes with risks that you're probably, and I say probably, going to underperform the S&P 500. So if you go into it with the expectation that this is a risk reduction strategy, I think it could be useful for you. But I would strongly recommend that you contact someone in your area, a financial planner or something, to talk about how this might work for you specifically and whether or not it works with your tax situation. All of those things are very important before you adopt this or any other strategy. If you're interested in even more investment content, I have a valuation course, which you can get 50% off of using the link in the description down below. We just discovered that we need a new roof on our house, so I'm really hopeful that people will buy the course so I can, at least partially pay for that. I think we got a little mold damage too, so that's fun times here in the Winkleplex household. 4 kids and a new moldy roof. Fun. That's fun. Thanks for watching, and I will see you in the next video.